What's the story with interest only? Welcome to the Property Imperative Weekly to the 24th of February 2018. Hi, I'm Martin North. Welcome to the latest weekly digest of property and finance news. Michelle Bullock from the RBA spoke about mortgage stress and investor loans this week. She argued that based on HILDA data from 2016, mortgage stress was not a major issue, but we beg to differ. But she also warned that there was a really elevated risk to property investors, and especially those holding interest-only loans. This mirrors APRA's warnings from the previous week. She said that investors have less incentive than occupiers to pay down their debt. Many take out interest-only loans, she said, so that their debt does not decline over time. If housing prices were to fall substantially, therefore, such borrowers might find themselves in the position of negative equity more quickly than borrowers with an equivalent starting LVR that had paid down some principal. The macro financial risks are potentially heightened with investor lending. For example, since this is not their home, she said investors might be more inclined to sell investment properties in an environment of falling house prices in order to minimise capital losses. And this might exacerbate the fall in prices, impacting the housing wealth of all home owners. As investors purchase more new dwellings than owner-occupiers, they might also exacerbate housing construction cycle as well, making it prone to periods of oversupply and having a knock-on effect to developers. So we did some further analysis on interest-only loans, and we identified already that conservatively 60 billion of loans will fail current underwriting standards on reset, and that's more than 10% of the portfolio. We discussed this with Ross Greenwood on 2GB's Money Show. But how many loans are interest only, and what is the value of those loans? That's a really good question, and one which actually is not very straightforward to answer, as the monthly stats from the RBA and the ABS don't split out interest-only loans separately. We think they should. The only public source is from APRA's quarterly property exposures. The next edition to December 2017 comes out in mid-March, hardly timely. So we have to revert to the September 2017 data, which came out in December. This data is for all ADIs with greater than 1 billion exposures of term loans and does not include the non-bank sector, which is not reported anywhere. They reported that 26.9% of all loans by number of loans were interest-only loans, down from a peak of 29.8% in September 2015. And they also reported that the value of these loans was 35.4% of all loans outstanding, down from a peak of 39.5% in September 2015. So what does this trend look like? Well, the first chart shows the value of loans in September 2017 was 549 billion, down from a peak of 587 billion in 2017. The number of loans outstanding was 1.56 million, down from a peak of 1.69 million loans in December 2016. If you plot the trend by number of loans and value of loans, we see that the value exposed is still very, very high. Finally, the average loan size for interest-only loans is significantly higher at $347,000 compared with $264,000 for all loans. Despite the fall in volume, the average loan size is not falling so far. And the point is this: the regulatory intervention so far is having only a small effect, and there is a large back book of loans written. So the problem of risky lending is not going away anytime soon. US mortgage rates continue to climb following the recent Fed minutes, which were more upbeat and continues to signal more rate hikes this year. As a result, average rates moved to their highest level in more than 4 years. Now, Moody's made the point that US government debt will likely rise by about 5.9% in the next year, significantly faster than private sector debt. Yet they argue that this might not be sufficient to drive rates higher. On the other hand, Westpac argues that the Fed may have to lift rates faster and higher than many expect, thanks to strong US wage growth and higher government spending. And they are forecasting rises of 1.25% ahead. This would have a significant knock-on effect. And in fact, the recent IMF country report on Australia forecast that the average mortgage rate in Australia would rise by 2% to 7.1% in 2021. That would cause some pain and lift mortgage stress from 920,000 households to 1.25 million households on our models. We heard this week that the ACCC is due to release its interim report into residential mortgage pricing shortly. As directed by the Treasurer, a key focus will be on transparency, particularly how the major banks balance the interests of consumers and shareholders when making their interest rate decisions. And the RBA minutes seems to suggest a wait and see approach to changing the cash rate. The Royal Commission continues its deep dive into lending misconduct and announced the dates for the next set of hearings in early March. But they also released a significant background document spotlighting mortgage brokers. The data highlights broker share is up to 55% of mortgages, and some of the largest players are owned by the big banks. For example, Aussie is owned by CBA. Separately, ASIC discussed structural conflicts from the relationship between financial planners and mortgage brokers and the companies who own them, and the commission structures which are in place. To reduce the impact of ownership structures, ASIC proposes that participants in the industry should more clearly disclose their ownership structures. When asked whether mortgage brokers should come under conflicted remuneration laws, ASIC's Peter Kell said that there's been a lot of work done on this, so it's difficult to get to a yes or no answer. But he says they're obviously highlighted in their ASIC report that they think there are some aspects of the way that the remuneration works in the mortgage broking sector that would be better to take out of the sector because they raise unreasonable conflicts. However, the Productivity Commission has gone a step further by calling for a legal provision to be imposed by ASIC to require lender-owned aggregators to work in the best interests of their customers. Draft recommendation 8.1 reads, the Australian Securities and Investment Commission should impose a clear legal duty on mortgage aggregators owned by lenders to act in the consumer's best interests. Such a duty, they say, should be imposed even if these aggregators operate as independent subsidiaries of their parent lender institutions, and should also apply to the mortgage brokers operating under them. This would be a significant and important change. We caught up with several investment manager teams this week who are in the country visiting the major banks as part of their regular reviews. One observation that came through from these is that when they visited the major banks, they told the managers that they thought there would be very little change coming from the plethora of reviews currently in train. So it will be very much business as usual. We're less sure, as some of the issues being explored appear to be structurally significant. Economic news this week included the latest wage price data from the ABS. You can clearly see the gap between the trend growth in the public and the private sector rates, with the private sector sitting at 1.9% and the public sector at 2.4%. The CPI was 1.9% in December, so no real growth for more than half of all households. Victoria was the highest there with the wage growth of 2.4%, and the Northern Territory recorded the lowest at 1.1%. So, if you want a wage rise, go to the public sector in Victoria. There were more warnings, this time from comparison site Mozo, on the risks of borrowers grabbing the cheap special mortgage offers, which are flooding the market at the moment. Crunching the numbers in the Mozo database, they found that homeowners could pay as much as 174 basis points more when the honeymoon period on their home loan ends. In fact, their research revealed that the average homeowner with a $300,000 home loan could end up paying as much as an extra $3,500 in additional interest charges each year if they're caught taking the introductory rate bait. But this could become an even more costly error when you consider how much extra interest you could end up paying over the life of the loan. And mortgage underwriting standards continue to be tightened as NAB has made changes to its home lending policy amid concerns over the rising household debt to income ratios and as APRA zeroes in on loan serviceability. So from Friday the 16th of February, the loan to income ratio used in its home lending credit assessment has been changed from 8 to 7. With the new change, loan applications with an LTI ratio of 7 or less will be processed as normal and will be subject to standard lending criteria, they said. But stop and think about this, because a loan to income of 7 is hardly conservative in the current environment. And in fact, when I used to underwrite mortgages, we used a basic calculation of no more than 3.5 times one income plus 1 times any second income. So we still think the underwriting standards are too loose. Finally, home prices continue to drift lower, especially in Sydney, according to CoreLogic, who also said that the final auction clearance rates across the combined capital cities rose to 66.1% across a higher volume of auctions last week, with 1,992 auctions held, which was an increase from 1,470 the previous week, where the clearance was 63.7%. But last week's clearance was still lower than the 74.9% a year ago, when volumes were a lot higher at 2,291, so the momentum is still sluggish. So standing back, we think lending standards and misconduct will be coming to the fore in the coming couple of weeks leading up to the next Banking Commission hearing sessions. Remember this, if a loan is judged to be not suitable, it opens the door for recourse to the lender, which may include cancellation or alteration of the loan. Now, if volumes of interest-only loans were judged not suitable, this could open the floodgates on potential claims. Things might just get really interesting. If you found this useful, do like the post, subscribe if you're new to the channel, or thanks if you already subscribe, and you can also leave a comment or ask a question. We read them all. I'm Martin North, Principal of Digital Finance Analytics. Do check back for our next post, and many thanks for taking the time to watch.